All of O-Levels business studies Section 4 definitions in 3 minutes. Productivity is the output measured against the inputs used to create it. The buffer inventory level is the inventory held to deal with uncertainty in customer demand and deliveries of supplies. Lean production is a term for those techniques used by businesses to cut down on waste and, therefore, increase efficiency, for example, by reducing the time it takes for a product to be developed and become available for sale. Kaizen is a Japanese term meaning continuous improvement through the elimination of waste. Just-in-time is a production method that involves reducing or virtually eliminating the need to hold inventories of raw materials or unsold inventories of the finished product. Job production is where a single product is made at a time. Batch production is where a quantity of one product is made and then a quantity of another item will be produced. Flow production is where large quantities of a product are produced in a continuous process. It is sometimes referred to as mass production. Fixed costs are costs which do not vary in the short run with the number of items sold or produced. They have to be paid whether the business is making any sales or not. They are also known as overhead costs. Variable costs are costs which vary directly with the number of items sold or produced. Total costs are fixed and variable costs combined. Average cost per unit is the total cost of production divided by total output. It is sometimes referred to as unit cost. Economies of scale are the factors that lead to a reduction in average costs as a business increases in size. Dice economies of scale are the factors that lead to an increase in average costs as a business grows beyond a certain size. Break-even level of output is the quantity that must be produced, sold, for total revenue to equal total costs, also known as break-even point. Break-even charts are graphs show how costs and revenues of a business change with sales. They show the level of sales the business must make in order to break even. Revenue of a business is the income during a period of time from the sales of goods or services. Total revenue is equal to quantity sold multiplied by price. The break-even point is the level of sales at which total costs equal total revenue. Margin of safety is the amount by which sales exceed the break-even point. The contribution of a product is its selling price less its variable cost. Quality means to produce a good or service, which means customer expectations. Quality control is checking for quality at the end of the production process, whether it is the production of a product or a service. It uses quality inspectors to find any faults. Quality assurance is the checking for quality standards by employees throughout the production process, whether it is the production of a product or a service. Total quality management is the continuous improvement of products and processes by focusing on quality at each and every stage of production. Thanks for watching.